We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dr. Nomi Prins, founder of Prinsights Global and its Substack, financial expert and best-selling author of 7 books, including All the President's Bankers, Collusion, and her latest, Permanent Distortion. Nomi, thanks for joining me today.
Thank you so much, Tom.
Great to speak with you again. And I think, obviously, it seems like a broken record to mention the fact that we have almost nothing to talk about. Of course, we're recording this on, let's say, the afternoon of November 7th here. So I want to start by asking you if the election fundamentally changed anything about how you view the current markets and your outlook upon them.
That's a fantastic question. I think what the election did do is confirm a lot of the things that I've been following and saying, which is that there's a massive disconnect between the financial markets, how they're funded, why they move the way they move, and the real economy and real assets. So from the standpoint of the real economy, what the election showed is that people are concerned that wages haven't kept up with inflation in all of the counties that consolidated gains or flipped to Trump from the last election. And that, these kitchen table economics really drive or had driven a lot of people's overall decisions, exit polls, and so forth into this election. And so from that standpoint, it isn't surprising. We've heard a lot of headlines saying that, U.S. economy is strong, GDP is high, and so forth. But if you wipe away the fact that GDP currently is about 2.8%, are expected to be that for this quarter. Inflation, core inflation outside of food and oil, taking that away is about 2.2%. We're looking at a fairly flatlined economy. And if you zoom out from 222 on through today, take out the COVID downward and upward moves, pretty much we've been flat. And so what does that mean? It means there's also been not a lot of or enough investment in the economy, in its infrastructure, in processing, in manufacturing. There has been some, but not enough to make economic growth outpace inflation or outpace the amount of debt that the U.S. has accumulated in general and over this most recent 4 years and the 4 years before that and so forth. So what all of this means is that the economy itself actually, I don't think, is healthy. It's floating on debt. The deficit is high, and people basically voice their concerns about their individual personal economics fairly loudly in this election. So none of that was particularly surprising. What it also indicates in the wake of the election, the markets went upward crazy from the NASDAQ to the S&P to the Dow. They were doing fine relative to the economy anyway into the election, but they really zoomed upwards in the wake on a number of things, potential tax cuts, other potential deregulatory moves that could help M&A and all sorts of other things. But all of that's a financial mechanism. It's not actually helping the real economy either. So as I wrote about in Permanent Distortion, there is still a distortion at the moment between how money gets printed, where it goes, and how it accumulates and where it accumulates versus the real economy, how people live, and how real assets and hard assets and resources are extracted and processed and used.
Mm-hmm. So, Nomi, when we think about what the actual, let's say, the Trump campaign had promised for economic decisions, it didn't seem like there was very specific policies that we could point to that really showed any even consideration of the debt and deficit. So am I wrong in thinking that? And where did people get this idea from in actual tangible policy decisions going forward that made them feel that the economy is going to be at least maybe not stimulated, might be the wrong word, but, ameliorated in some way, calming this feeling of uneasiness in the population or in the labor force?
Yeah, it's interesting because I think a lot of people's expectations are that it can't get worse, and so no, I think it was
Mhm,
coming from the standpoint of answering that basic question, right? The Reagan question, the question that Trump reiterated and posed. Are you better off than you were 4 years ago?
mhm,
And when people were asked that question, or enough people, obviously the majority of the population, in terms of the election result numbers, were asked that question, they kind of looked at their own personal economies and said, well, you know what? I might be making more, but my costs are higher. So net net, I'm actually sinking. And there's an anxiety to that. It doesn't mean that they might not have some money in the markets, and the markets have been going up and so forth. But looking at most people at that, sort of kitchen table conversation, or that internal conversation with one's family, what it came down to was, um, I have an uneasiness. It accumulated during this administration. And on the margin, I don't want this to continue. And there was that connection of Kamala Harris too, because she was a part of this administration, the administration.
mhm,
I don't know that she could have done more to distance herself, given that she is the vice president. But I also don't know how much that would have mattered in terms of articulating economic policies to grow, which there were some, but not a lot. So I think both candidates didn't specifically talk about the debt and the deficit, as you mentioned, because um, they really can't articulate a plan to substantively change that.
mhm.
From the standpoint of Trump, again, people or more people voting away from their unease to something that's hopefully better. What he did was provide sort of reason, the immigration reason for people to potentially consider as why they're feeling the way they're feeling, and inflation as why they're feeling the way they're feeling, and how you get out of either economically. There wasn't really so much of a plan on the economic side,
Mhm.
and the plans that are in place, higher tariffs or reduced corporate taxes, don't necessarily um, provide lower debt. They actually potentially increase the debt, which therefore increases the deficit. And even budget cuts, let's say we now have a Senate that's controlled by the Republican side, potentially a House as well, and votes are still coming in, and obviously the White House. There could be budget cuts, but you can't cut $1 trillion off of the budget. So at most, these are going to be tweaks. And so there has to be a better, I think, plan coming from this administration as to how you actually grow the economy beyond its debt
Mhm.
versus just tweaking the debt or tweaking taxes.
Nomi, there's always this balance, and there's so many different, you know, pieces to consider when we're trying to, let's say, conceptualize each side of the scale here. So if we take the idea of tariffs alone, obviously Trump is very well known for wanting to basically put tariffs on everything and everyone. How does that end up coming back, and does that end up costing the consumer and the domestic economy more for any type of imported good?
It mostly would cost the consumer more, simply because if we look at supply chains as being global, which a lot of them, most of them are, from the standpoint of materials, whether it is steel, whether it's aluminum, whether it's lithium, whatever it might be, you have a global supply chain,
Mhm,
food, natural resources, and so forth. And so if you are putting tariffs on a portion of that supply chain, even if it's only on the exports from China that come into the United States, and what the Trump administration has said in advance of taking office, this time around in the campaign period, is that they could possibly put 60% tariffs on a number of items coming out of China, and potentially between 10 and 20% on items coming from anywhere else. So the idea of doing that means that you're taking a piece of a supply chain and you're effectively reducing its supply. And so the other side of that means that, well, if demand stays the same and supply is reduced, then generally prices rise.
mhm,
That's just the general form of economics. If you control the whole supply chain for a particular item, that's different because you control all the parts. But if you're only controlling or sort of tariffing a component of it, then manufacturers, restaurant owners importing anything in terms of food items or whatever might be tariffed, sort of up the chain, would potentially pass that on. If you're making iPhones, if you're making computers, if you're making girders sort of externally to use to build bridges here, whatever it might be, and you need the materials to do that, those costs are going to be put on to, if not the middle person, the middle company, but the end consumer. Mm-hmm. And so that actually increases inflation. It didn't increase overall inflation during the first Trump administration because even though there were tariffs put on a number of commodities and on products, they were actually very specific. They're sort of ring fenced in. So we did see higher prices in things like aluminum and things like steel in certain elements that there were tariffs on, and then subsequently those tariffs were reduced. So it really depends on where we are in terms of how those tariffs come down. But initially, unless we have the capacity as a country, and this is where I talk about having a growth project or strategy as well for the country as a whole. If we can participate in multiple parts of a supply chain, then we have the ability to reduce overall costs. Mm-hmm. But until we can do that, tariffs can hurt the consumer and can cause prices to rise.
Right. Yeah, of course. I mean, I think I'll probably be referring to this scale a couple more times here, but again, it's always this balancing act. But, obviously all eyes and everybody's mind is fairly focused on the presidential election, but are there actually, more important elections that investors should be paying attention to?
Well, I think the fact that the overall election, for example, the Senate, in moving into onto the Republican side, means that there are certain initiatives that the Senate will put forth that were either bipartisan or might come from the Republican side that have a more likely chance of being passed. Because what you have is any of the committees that were potentially run or that were run by Democrats in a Republican House are now run by Republicans. That doesn't change everything. It actually doesn't. But what it does do is put more emphasis on areas where there's bipartisan or will be bipartisan agreement. Because that's which are going to potentially be brought up by the Republican side as committee chairs versus Democrats who will no longer be committee chairs. But there are many of those. Those span the energy sector. They do span domestic supply chains. They do span competition with China. They do span semiconductor and fabrication. They will have elements in water, in waste management, in solar, in oil and in natural gas and so forth. So there's a plethora of bipartisan initiatives that can still come out of a Republican Senate, but it will skew towards that side, and will probably also skew towards laws or proposed laws that will probably get passed that are more deregulatory in nature. Mm-hmm. Because what happened in a lot of these industries, a lot of these sectors that I just mentioned, is that from the Republican standpoint, there was a concern that there was too much red tape in terms of, opening a mine or building a pipeline or whatever it might be. And so one of the things that's likely to come out of this particular Senate, and also if the House maintains its majority, is more deregulation across multiple industries, across finance, across energy, across infrastructure, across natural resources, across other things. And so that's going to be something to watch for, because those sectors, if they are deregulated, depending on the sector, can have two outcomes. If it's finance, generally it means, I think, risk. If you deregulate finance too much, it's good for the bankers, it's good for Wall Street, it's good for M&A, it's good for the market because things happen more quickly and more easily. But it also can create a lot of additional risk into the financial system, and if that risk becomes bad risk and creates some sort of a crisis, then that's a costly problem. In something like permitting new infrastructure and new projects, new engineering projects and so forth to build infrastructure, that can be a positive because that can simply create a faster mechanism for getting things done. And a faster mechanism for getting things done from an infrastructure and energy and transportation logistics perspective means that it's cheaper to actually create because it takes less time. So if prices are going up in any small or larger way, and projects can be contained and take less time in the initial permitting or regulatory permit stages, that can decrease the amount of time to implementation. And then, of course, it's on a per project, per sector, per company basis as well from that point on. So I think those are the things that we're going to see is deregulation, domestic isolation type of initiatives, more sort of anti-China or competitive versus China type of initiatives, which are already bipartisan, but just potentially more of them and passing more quickly than we had in the last Senate. So those are all areas to watch.
Mm-hmm. You mentioned this idea of deregulating certain sectors, especially the energy sector. What does that end up meaning for the sector as a whole? Trump's policy of drill, baby, drill seems great on the surface and, as a catch line maybe, but is there more to understand from the Permian?
From the Permian standpoint, it has to do with additional drilling, additional sites, additional pipelines. So it sort of runs the gamut from physical ground through to logistics, engineering, to infrastructure, to transportation. And so if any points along that path have less hurdle or less regulation or can be passed by executive order if necessary, whatever it might be, then it means that you have the potential for things to happen more quickly. Of course, you also have the potential for things to happen that are less environmentally sound or less safe as well because of that lack of regulation. So it is a balancing act. From the standpoint of oil, moving on to natural gas, there is also the capacity there's a lot of places that can expand on basins that are already in existence in terms of finding more capacity, and that can be something that can quicken in terms of less regulation or less time that it would take to permit growing those areas. The same thing is sort of true on the west side of the United States with respect to mines that relate to uranium or rare earths or some of the other types of natural resources that either work for our electrification like uranium or our magnets, our permanent magnets in our defense like rare earths would. And to the extent that those processes are more streamlined, you can see more supply coming from the United States versus its allies. So that's what all of that can mean. Of course, again, the other side to that is safety measures, environmental measures, sustainability measures that are also all part of economic health in those sectors as well that would need to be addressed also. Waste management, things that are a part of all of these energy endeavors.
Mm-hmm. So obviously the U.S. is very reliant upon the Permian Basin to be drilling. And I was reading through some of your print sites on your new Substack since the last time we spoke, and it was pointed out that there are some analysts that expect, basically a cap, not a cap, but an end to the growth of that production. And if I understood you correctly, you're saying that, on the whole, the U.S. as an entirety has a lot more capacity in these other basins to make up for that, right?
Yeah, I mean, I think that area in general, and the Permian Basin is not. It's not stopping. It's not going. There's plenty of rich resources there, and that will continue. And that's why companies that are involved in that are able to pay such high dividends for what they're doing. I mean, there is certainly more capacity there. But yes, that entire area, so Louisiana, Texas, and so forth, that entire area does have capacity and can continue to be a part of our overall energy program. And the interesting thing, just to expand a little bit on that energy curve, I think of it now as an energy curve. So, we have oil, natural gas, coal, and then you have sort of uranium in the middle, and then you have more renewables like solar and hydro and geothermal and so forth, which require the base load to be secure in order to come in and all have their expenses and all have their roles. And I think we're gonna see with this administration that as much as there will be focus on the oil side and natural gas side and the coal side, the focus on the entire energy spectrum is going to grow. There will be focus on solar. There will be focus on nuclear specifically because that is a growth area, and that will not necessarily mean that oil and natural gas won't have its role. It absolutely will. But 20% of our electricity in the United States right now comes from nuclear power, right? So I mean, there's different numbers to look at in terms of where energy is going to come from, where the resources are going to come into the grid, and also how we actually update our electrical grids in order to to work with that capacity, how it gets from effectively the ground to our homes and our businesses and our factories.
Mhm. You kind of brushed over a little bit of an idea that I wanted to introduce a little bit more formally here, and that's the idea of the US building a strategic mineral reserve, whether that be permanent magnets, uranium, all of these minerals that at this point we don't necessarily have much domestic capacity to either produce and or refine. So how could this strategic investment, what are some of the details of it, and how could it actually escalate tensions with China as a byproduct of that?
That's a really great question. We did have a recent piece on that. It was very sort of wonky, I think, because we went into some detail. Thank you for reading it. We went into detail in terms of some of the legislation that and the ideas that have come up through actually the first Trump administration and the Biden-Harris administration, and I think that will be continued now under the next Trump administration, which is that in order for us to have independence from China from an energy perspective and a technology perspective, because both are part of how we maintain national security and economic strength, we need to have supply. And the idea of having an oil reserve has been around for a long time. That's accepted. We have that, and we monitor how much we have, and is it up, is it down? What does that mean in terms of how we position ourselves geopolitically with respect to other oil giants and so forth? So that's pretty baked into our ethos, right? Having a critical mineral, which also would include the 17 rare earths elements, which are intrinsic to permanent magnets, which run a lot of our defense systems, our satellites. They're in our refrigerators. We basically have multiple uses for permanent magnets, as well as industrial battery minerals and elements are very key to us storing energy, storing it cheaply, storing it efficiently, and therefore also help our economy and our energy independence. So that idea of a critical mineral reserve, a strategic mineral reserve, was actually brought up during the first Trump administration, as I said. And that was when the Department of Energy first created its 50 named critical minerals, which include those rare earths. And the idea of them being critical was that we don't have enough capacity on our own. So therefore, there's a risk to supply. And that's basically how they were selected. So that risk to supply actually is another way of saying an exposure to Chinese supply or Chinese ally supply and Chinese processing of some of those elements as well. And we buy processed elements from China or chips from China that include these elements or whatever it might be. So to the extent that we can create our own, and it would likely be from allies as well as our own land or underneath our own land, because we simply would not have enough on our own. I think that will be something that will continue to be pursued. We've seen a lot of domestic supply legislation come out, particularly recently in uranium in the wake of what's gone on with Russia and Ukraine, and a lot of legislation about advanced technologies on nuclear and uranium and so forth. And I think now we're going to see that move and expand into the critical minerals and strategic minerals space.
So as I understand it, it's not just identifying what these critical minerals are and wanting to build a stockpile of them. But obviously, there needs to be major investments made to make all of this happen, whether that be production or refining capabilities. So is there major capital being deployed as part of this as well?
Well, currently there has been capital that has come in from either the Inflation Reduction Act or other types of separate acts, the bipartisan infrastructure law, that has gone into some of the processing and some of the development of these areas. So, for example, there is processing that's being developed in North Carolina. There's processing that's being developed in Colorado, in Utah, and Wyoming. There are certain states where we actually have had money come in from the government in order to supplement private industry and private companies and build out processing capacity. Mm-hmm. So some of that is open, some of that we have, and some of that is in construction. It's small. We're talking about a few $1 billion out of the budget versus potentially needing much more than that. But what it means is if we have processing capability in Louisiana or North Carolina or so forth, we can actually bring in some of the raw materials from allied nations into those areas, process them here, and then use them for whatever products they might be needed for. Mm-hmm. And that's where I think we may see, again, bipartisan support coming out of the Senate, coming out of this House, coming from the Trump administration itself to do that. And also, if we look at the Elon Musk factor, in all of this, for example, he has been a proponent of having domestic supply, his own supply, basically, of materials that are needed for whatever they might be needed for in terms of battery storage, in terms of magnets within cars, in terms of systems within SpaceX and so forth. So he is going to, I think, be a key voice in the background or in the foreground, depending on how. I don't think he's quitting his day job. I don't know, but in sort of some directional capacity role in talking about what's needed and how it's needed and how much money the government should be spending in addition to what private capital is doing or what private companies are doing.
Mm-hmm. Nomi, one of the, let's say, the sectors or the industries that seems that would have benefited either way from an outcome of the election is the nuclear energy industry. Between AI and this, let's say, renewed optimism or new acceptance, let's say, of the nuclear energy industry, is this something that you see as an unavoidable growth sector at this point?
Absolutely. I mean, it's probably one of the main areas that I tend to have written the most about. We write the most about it at Print Sites. If you had to take like one area, one sector, and one element being uranium, because as I started to mention before, we've seen so much new bipartisan support for the nuclear industry, and not just updating the old nuclear plants, because there are technology companies like Microsoft that's happy to do a deal with Constellation and be like, open up, 3 Mile Island because we need that power. There are a lot of those deals across Amazon, Google. They're all looking for ways to basically provide their own power. And actually, I was just talking to an AI specialist yesterday about this idea of tiny machine language or TML capacity, where it would be equivalent to what is an SMR or a small modular reactor or a micro modular reactor, which would bring nuclear power to where it is needed. And so, just sort of reduce the cost and the length of getting it, from one place to multiple places, just having it exactly where it's needed. Same thing with machine language and big AI processing mechanisms that would basically, or an edge computing that would move the power that's needed directly to where the AI is using it. But again, how do you create that power? And this is where nuclear comes in. And again, that's that circle between technology and AI and nuclear. Matching that onto where there's additional legislation that hasn't been passed yet, that's prevailing in Congress right now, and that I think has a lot of chances in the next Congress because it has bipartisan support to happen, is additives to Nuclear Fuel Security Acts, which did pass, additives to the Advance Act, which is looking at the technology of nuclear and how to make that more efficient, and how to make the waste more basically more contained, and so forth. So all of those things which have been passed have helped the nuclear industry, and they basically said that, look, the United States is here in nuclear and it's here to stay. Yeah, it's 20% of our electricity is coming from nuclear, and I think that number is going to grow. And of course, you need uranium to do that. Now, China is producing many more. I think it's about 5-to-1 nuclear power capacity, either plants or investments in small modular reactors and the like, than the United States is doing. So there is a competitive disadvantage that we actually have in nuclear power relative to China. Now, we don't need their power, and their power is powering their country. But at the same time, what it does show is that the two superpowers are in this nuclear race. And you add in Europe, and you add in all the promises that countries have now made in the last couple of years to increase their nuclear energy supply by 3 times by 2050. All of this is part of a really unstoppable trend. And then you add the fact that nuclear energy is a very stable baseload energy. So again, even if you have oil, natural gas, and coal on one side, and you have all the other alternatives on the other side, nuclear is that pivot. It is the fulcrum. It balances both, because you could turn it on in a second. It's cleaner than fossil fuels, and it's more reliable than the natural resources, the sun, the wind, and hydro, and so forth. So I don't see it changing. I don't see it stopping. I think if anything, it's going to increase the demand for uranium, and particularly from the United States perspective, uranium from allied nations, because we don't have enough here. We have one current operating uranium mine. There are more coming online, and there will be more coming online in the future, but we will also be using allies.
Mm-hmm. What do you see as the biggest bottleneck within that industry? Is it just production and ability of the market to supply these utilities out through the future as they need this material?
There are a couple of things that happened. First, until the last couple of years, there was a little less focus on nuclear energy. Again, even though it's powering so much of our country, there was a lot of conversation in Washington about how the Republican side was actually pro-nuclear and pro-power plant and pro-mining, and the Democratic side were more, that's not environmentally friendly. Are there other things we can do, et cetera? There was just a lot of back and forth, and not a lot of acts were passed, and not a lot of stuff was done. And then you add into that, when COVID happened, these mines take a lot of money to operate. There's a lot of money that's required to process. There's a lot of money that's required to process waste, and so forth. And so there was a lot of closing or not reopening, and no opening plans for uranium mines during that whole period. And so now we're in a period where they're just popping up again. And what has stopped or made that less quick than it could otherwise be, according to a lot of the CEOs running the uranium companies, is the red tape involved in permits, involved in getting okays from the government, and so forth. And so, again, I think that's going to be somewhat easier. And the demand is certainly there, and the trend is certainly there. And all of those things, I think, is going to help. We're going to see, I think, more mines and more processing opening up in the United States over the next few years.
Mm-hmm. I'd like to pivot a little bit from let's say the commodities and energy to talking a little bit about the dollar here, Nomi. It moved up sharply right after the election result was announced, obviously. Does this bode well for the future of the dollar, or are forces like the de-dollarization and rise of the BRICS and their moves forward in building an alternative trading currency, really starting to catalyze that process of de-dollarization?
Both things are true. In that, yes, the dollar has consolidated in the wake of this election, and the dollar is still the world's top reserve currency, and it is still the thing that when uncertainty either pops up quickly or certainty pops up quickly, it tends to be the go-to currency. And I think that when we look at the dollar index, the DXY and so forth, or the dollar relative to other currencies, that those reactions tend to happen much more quickly than the larger trend that's happening, which is de-dollarization. De-dollarization requires trade agreements in currencies that don't involve the dollar. It requires payment platforms in systems that don't settle in dollar. There's a lot of infrastructure that's required, and it has started to be put in place, and I think will continue for de-dollarization to really take hold. And as a result, we saw, for example, last year that about 20% of oil trades were settled outside the US dollar. 10 years ago, that would have never been the case. We had the petrodollar, that was it. So what's happening is there's the trading dollar and the reserve dollar, and then there's and those two things are separate. The trading dollar, that de-dollarization trend is growing. The BRICS community and the expanding BRICS community, more and more countries want to be a part of it, is growing. And it has its own natural resources, and it has strong and rising economies. And even though they don't all agree on things politically, it's not a political bloc, it's an economic bloc. So from that standpoint, that bloc wants to have an alternative to the dollar. That doesn't mean it's not going to trade in dollars tomorrow, but it's actively developing an alternative. So when we look at things like BRICS Pay, or we look at what's going to happen at the G20 in Rio, one of the number one or top two conversations that will be had is around a payment system for a non-dollar based settlement strategy. And so that's going to grow. And that fuels de-dollarization. So both of these two things are happening. On the surface, we got these quick reactions, money coming into the dollar, and then long-term de-dollarization is continuing. And it doesn't get captured in the DXY because it is long-term. You can't capture a new trade agreement that says, for example, all financial transactions that are going to happen between Chinese and Russian banks are going to 100% be settled in either one of those two currencies. More and more percentage of them are being settled in those two currencies. There's swap lines between the ruble and the yuan, but it doesn't feed into that dollar up, dollar down quick measurement. So long answer, but it's really, I think, important to know that these two things can happen at the same time.
Mm-hmm. Yeah, that's something that I've been kind of harping on recently on the show is, taking these longer term timeframes, understanding that many of these rebalances happen over a longer time frame where we don't necessarily have the ability to be able to pay attention to it on a day by day basis. This is something that takes patience and understanding that it isn't just an acute catalyst in a lot of ways. But
yeah, and it needs architecture. I mean, this is the thing. A payment system requires like a minute to be tested, to connect to financial systems, to connect to corporations, to have money go through different countries and ultimately be backed potentially by the central banks of those countries. There's a lot of steps along the way. If you add into that, for example, China's payment system, CNY, is something that is based on blockchain. BRICS Pay is going to be based on blockchain. So there's a lot of technology that's being built that wasn't there or isn't there, for example, in the SWIFT payment system, the dollar-centric payment system. And the number one thing that you need if you're trading with countries in any currency is to make sure your money goes through, right? So to have that infrastructure sounds like, oh, it's just a payment system. Don't we just all have those on our phones? And these things need to be tested. It's not that simple. And if there's a lot of data going through them and a lot of testing that needs to be done, as is with the current payment system that China has, and I think it was like 148 different institutions are now involved in it. That's kind of up from nothing a few years ago. These things do take time, but they're also necessary for the process of de-dollarization, and they are happening.
Well, to your point, I think it takes a minute as well for these countries who, some of them are adversaries, to agree upon how they're going to trade, what they're going to trade, what that system ends up looking like. Does this end up, kind of making gold a very important piece of this picture within that framework?
Yeah, it absolutely is. I mean, one of the things that we've seen obviously is gold prices rise, but for a number of reasons, and these are all reasons why it's going to continue to rise, and the miners that are actually taking gold out of the ground or have a lot of capacity or are buying or acquiring other projects are going to benefit as well, is because, again, multiple points of gold. The one that gets discussed a lot is central banks buying gold, and yes, they are, and yes, they're buying gold in record volumes, and yes, this has been increasing since basically 2018. Just so this is still kind of new. If we look at where China is, for example, in their reserves of gold relative to like all of their reserves, it's only 5% of their reserves. So there's of their central bank reserves. So there's a lot more room, for example, for China to balance its reserves towards gold, even though it's one of the central banks buying the most gold. Banks like Poland, banks like Turkey, there's other banks that are buying gold, but central banks, but it's moving upward. At the same time, looking at the People's Bank of China, their central bank, their buying of U.S. Treasuries has gone down dramatically. Since 2018 to now, it's gone from 1.3 trillion buying treasuries down to 750 billion. So their holdings. So effectively, they dropped in half their treasuries. They've increased their gold, and they're still only 5% reserved in gold. So that can, and the trend is up. If you look at that across the BRICS and across the world, there is a tremendous interest and tremendous demand for continued gold buying, and that is only about a fifth of gold buying in general comes from central banks. That's only one element that we hear about that is definitely motivating gold upward. But when we look at, for example, in China again, or in India, in Egypt, and so forth, the average consumer, the average retail person is also buying physical gold, buying more physical gold, jewelry, bars, things that can be protected. And that's happening throughout the world. And then you have ETFs, which is the other way to get involved in gold from an investment standpoint, many of which are backed by physical gold. So as they grow, the managers have to buy the physical gold, which is why it's important to only buy gold ETFs or silver ETFs that are actually backed by the physical anyway, because it's there. It's less ability to, it's less able to be manipulated and so forth. But there's all these areas that are involved in purchasing gold for reasons of hedging risk, geopolitical risk, currency risk, central bank risk, banking system risk. And so gold has a part of all of that. And it's only going to continue. These countries aren't going to turn around and say, you know what? We'd way rather sell all of our gold now and just go back into dollars. It's just not where we're at. From a superpower geopolitical perspective. So there remains tremendous upside for gold. I don't remember exactly when we last had this conversation, but I thought gold will reach 3,000 this year. We may get close to that, but for all those reasons. And the more there's tariffs, the more there's supply chain disruptions, the more there's geopolitics that impact trade, the more impetus for central banks, for governments, and for their people to be invested in gold and silver as well.
Well, one of the points that I had kind of written on here was, the US isn't the only one making a critical mineral reserve. Russia actually released plans about that recently and deliberately mentioning that they wanted to stockpile silver. So, do you see, any way but up for the demand of silver yet?
No, I mean, the same thing. Again, you could have intermittent market conditions, rumors about manipulation, et cetera, that could bring silver down any point in time. But silver prices are also very geopolitically motivated, in addition to it being an industrial use value element. And so a lot of those stockpilings has to do with energy. There's this loop here, and there's a lot of interconnections in growing areas. And energy requires solar panels, for example, in particular, requires silver. India is the number one importer of silver in the world. They import this year, I think it was 4 times more so far than they did for all of last year. Why? Because they're repurposing a lot of their solar panels. They're also one of the 3 largest solar energy users into more advanced panels, and that requires more silver. China's doing that. Russia's doing that. We're doing that. So there's definitely more growth there. And going back to Elon Musk, because I was just looking at their numbers for the last Tesla results, and just us talking about what his role could be, and generally where it's at. $9.4 billion, or 9.4%, about 10% of their net revenues came from solar and battery and energy services. That's very much dependent on silver. And that was one of the larger growing areas in that constellation. So these are things that are happening all over silver, and there's not enough silver out in the world. There is a lot of silver in the ground. There's a deficit in terms of the supply of silver right now to meet this demand that's coming from all over the place. And the final thing to say about silver is when we talk about gold and silver and central banks can purchase silver not just for critical mineral purposes or energy purposes, industrial purposes. Many central banks have the ability to use silver as a reserve asset because of its properties. The BIS, the central bank of central banks, has indicated gold as an asset, as a reserve asset because of its high qualities. Many central banks also are allowed to buy silver from existing mandates. The Bank of England can buy silver, India can buy silver. They can move on to using silver after gold as a reserve asset. So if you look at everything expanding from that capacity, you're also going to see more demand from silver from a group that isn't even demanding silver right now.
Mm-hmm. Yeah, that's an interesting thought. I've heard it said before that central banks wouldn't consider it because it's too bulky to store. But as you say, as a derivative of gold and a, kind of down the line, I think it's a perfectly reasonable argument. Go ahead.
No, I was in the 30s. It was a Bank of England, Bank of India, where central banks were sort of the largest holders of silver, and obviously it was worth a different amount than it is now, and there were probably storage issues then relative to now, but they figured it out then. So I'm imagining if there was, the storage argument isn't necessarily, I think a deterrent, because they're not going to buy if they go into silver as much silver as gold, because you would require much more to do that, and hence the storage issue. But it wouldn't be that. It would be just a balance. It would just be an offset of another hard asset with value that they are allowed to use as a reserve asset.
Mm-hmm. Nomi, you had one short line at the end of one of your recent Substacks, and that was that banks could possibly diversify outside of the dollar into gold and maybe into gold miners. Explain to us how that could possibly be. So
if we look at the fact that banks, let's look at US banks right now, they have a relationship with the Fed where they have to put some money in reserve at the Fed. There's rules for that, how much they need to hold relative to their assets, relative to their size. And it's based on liquid assets, right? So that's why they hold treasuries at the Fed. And that's also why the Fed is able to do quantitative easing and just sort of print money and buy treasuries. It's all very easy. There's no storage issues with treasury bonds. Mm-hmm. But to the extent that the BIS allows central banks to also offset reserves or have a component of their reserves with gold, and it's a high quality asset from that perspective, there's reason to assume that banks could do the same thing, because banks are basically the counterparty of central banks. Central banks provide liquidity to banks, and banks put reserve assets with the central banks to be there in case of emergency, as sort of chips to call upon. Mm-hmm. So if central banks can have gold, there's no reason that banks can't also have gold for the purpose of acting with central banks, for the purpose of potentially having reserve assets like gold that count as same as treasury bonds. And so in that respect, net of any sort of speculation or investments banks could do anyway, or on behalf of their customers anyway, this is another avenue where they could potentially use it as a reason to buy more gold.
Mm-hmm. Yeah, it's an really interesting thought to consider, and especially obviously that gets, people that are interested in gold and miners gets their wheels really turning as well. Nomi, as we wrap up here, I'd like to ask you, where you see stress building within the financial system. One place I kind of wanted to at least highlight or ask you about with the bank failures that we saw nearly 18 months ago, many expected to see more of these banks fail. Obviously, the idea of duration mismatch and this liquidity risk being a big reason for a couple of those failures. Is there more smoke within these banks because of that duration mismatch, or do many of these rate cuts help to solve this depending on this duration that these banks hold?
I don't think these rate cuts solve that problem. I think what's happening right now is there's been a lack of marking assets to market, or basically being very honest with how some of the loans, particularly to commercial loans in the office space area and commercial real estate and so forth, are actually going. And so we're not really getting a full picture of portfolio risk across those loans that I think is accurate. But also, if you cut rates at the beginning of the curve, which is all that the Fed can do, and they're not currently doing quantitative easing, so they're not buying bonds at the moment. They're holding a lot, but they're not buying bonds at the long end. And we're seeing the long end steepen because of other fears. We've seen sell-offs in the long part of the in long-term treasuries because of inflation fears, because of uncertainty fears, because of supply chain fears, because of tariff fears. So there's still a lot of negativity on the long side. So what does that mean? It means that the rates for longer-term loans haven't really come down. They've come down a little bit, but they're not coming down dramatically. So even if they come down more quickly at the beginning of the curve, all we're seeing is a steepening of the curve. That doesn't really help things like a 5-year lease coming due on an office building that only has a half of its offices being rented out, or a third of its offices being rented out. We are still continuing to see that happening across the country, whether it's malls not being able to fill all of their stores and therefore their rents, whether it's office space. We're not really seeing that come back, which means that the assets, the buildings that contain those units are losing value. Mm-hmm. And cutting rates right now doesn't really change that fact. And you add on also that a lot of the loans that were taken out, shorter term loans in terms of building or developing or renovating, and also corporate loans in general that were taken out 5 years ago, and there's a lot of 5-year loans out there, were taken out at very, very low rates. And if they have to be extended, they're going to have to be extended at higher rates, because that's just where we are right now. Mm-hmm. And so that's going to put tension into the credit system and tension onto bank balance sheets. So I think the fact that we haven't seen anything major pop up is more the fact that there are rebalancing, there's portfolio trading going on back and forth within the banking system. And I think a lot of the evaluations are a little shady. And I do see more potential bank failures coming because of all of that.
Excellent, Nomi. I really appreciate you helping highlight many of these issues that we don't necessarily think enough about today. Would you like to leave our listeners with something to think about before we wrap up here?
I first of all appreciate your time. It's great to be back on, and your listeners were really awesome with comments last time. I did look at some of them, and I appreciate the build that you have, and everyone who comes and listens to you on this show. I think we're in a really interesting period. Yes, we have a new president who is an old president who's coming into play again, but we also have a lot of policies that that are going to extend across the energy sector, commodity sector, and so forth, that are really important to watch right now in the context of geopolitics and what the rest of the world is doing. And it's a fascinating time to continue to look at that. When you think of investing into that, it's a really important time to be diversified, not just in stocks and in different stocks, but in precious metals, in commodities, in rare earths, if you're a bit more adventurous. And I invite anyone to come and take a look at some of the work that we do at prinsights.substack.com to really continue to move our analysis forward as all these transformations move forward as well.
Mm-hmm. Yeah, it's an excellent Substack. Lots to read there, even if you just want to check it out. Of course, you have the paid options as well. And excellent Twitter follow as well, at Nomi Prins. Nomi, thanks so much for your time today. Really appreciate it.
Thank you so much. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.